welcome to FinBot Insights. Today, we are going to pull back the curtain on the high-yield covered call ETF ecosystem, and more importantly, the one company at its center that you absolutely need to understand.
And this really is the central question every single income investor must ask themselves. It gets right to the heart of whether those impressive yields these products promise are actually sustainable, or if there's something else going on under the hood.
Here's our thesis, and it's a stark one. These funds, by their very design, are engineered to decay over time. This is a critical structural flaw that often gets completely masked by the high monthly payouts they dangle in front of investors.
So, to really understand how this strategy became so widespread, you have to look at the architect behind it all. We are going to examine the one firm that sits at the very heart of this entire ecosystem. Let's be clear. Tidal Financial Group is not some small boutique firm. We are talking about a dominant force in this space, managing a staggering $50 billion in assets. And that $50 billion is spread across its sphere of influence, which now spans over 270 ETFs. This has effectively made Tidal the central, indispensable hub for funds that rely on these kinds of complex derivative strategies. Now, the firm's rise to this position was anything but accidental. It was highly strategic. You can see it culminated in that critical acquisition of Zega Financial's trading operations. That move basically integrated specialized high-level options expertise directly onto their platform, and it absolutely supercharged their capabilities. This table right here, it reveals Tidal's absolutely brilliant operating model. The firm acts as an ecosystem enabler. It provides the core machinery not just for its own YieldMax funds, but also for partners who, let's be honest, often just put a different label on the exact same underlying strategy. Okay, so now let's pull apart the playbook that Tidal has so successfully scaled across the entire market. Understanding this blueprint is absolutely the key to seeing the inherent risks involved. It is really a three-step process. You will notice this strategy deliberately sidesteps owning the stock directly. Instead, it favors a construction using safe U.S. Treasuries and options, all designed for one single purpose: to generate those income premiums. But here's the catch. This very efficient proliferation of the strategy also bakes in some serious systemic vulnerabilities. And I want to be clear, these flaws are not incidental bugs. They are fundamental to the design, and they are what undermine the long-term integrity of this type of investment. The most significant flaw, without doubt, is what is called net asset value erosion, or NAV erosion. This is driven by distributions that are overwhelmingly composed of a return of capital. Now, what that means is the fund is simply handing your own money back to you. It feels like a dividend, but it is not. It is just shrinking the asset base, your asset base, over time. You could say the structure's original sin is its capped upside. That short call option they sell forfeits all of the stock's gains beyond a certain point. So while your gains are strictly limited, you, the investor, remain exposed to the full unmitigated downside risk of the underlying asset. This chart shows that asymmetrical risk profile perfectly. If the stock soars, you get a tiny fraction of that gain. But if the stock plummets, you experience the full impact of that loss. This imbalance is not a bug. It is a core feature of how this strategy is built. So, to put it all together, the crucial point is this. These core flaws, the NAV erosion from return of capital, the capped upside, the dependence on high volatility, and the constant costs from rebalancing, these are not bugs in the system. They are features of the design, and they are replicated at scale across the entire Tidal-enabled ecosystem. Okay, so given all of that, how should an investor like you actually analyze these products? Let's outline a clear, critical framework. Think of this as your due diligence checklist. You absolutely have to look past the flashy headline yield. You must scrutinize the return of capital percentage. A high ROC is a massive red flag that the fund is cannibalizing itself. And you need to pay close attention to the strike distances of the call options they are selling. The closer those are to the current price, the more potential upside you're just giving away. Now, we have to state this unequivocally. This analysis does not constitute financial advice. It is presented purely as a framework for your own independent research and your own due diligence. You should not trust social media influencers on these complex matters, and that absolutely includes this channel. Do your own work. If you found this breakdown valuable, we would appreciate it if you would support our work with a like and subscribe for more institutional-grade analysis. Thank you for watching.